Okay, we are live this afternoon with personal finance educator Kelley Keehn. Kelley, welcome to our live broadcast today.
Oh, so great to be with you. Thanks for having me, Dee.
My name is Dilshad Burman. I am the web writer for CityNews and 680 News, and I'll be moderating this chat this afternoon. We've had a lot of questions come in for Kelley, so we're going to get started right away. We want to squeeze in as much as we can in this half hour. Are we good to go, Kelley?
We are good to go, Dee.
Excellent. Okay. So let's start off. We've got a ton of questions that came in about RRSPs. People are quite worried about those right now. So let's start with SK. SK asks, for a first-time risk-averse investor, is it too risky a time to start investing your RRSP savings? And if not, what kind of investment would you recommend for someone who has very low risk tolerance?
Right. So let's first talk about, should SK even be in an RRSP or just investing on the side? Now, we're going to speak in some very big generalities here. I would hope that this individual would maybe reach out to someone like a certified financial planner or a qualified associate financial planner, or make sure they're really digging into a good investment advisor and they know the questions to ask. That's super important. Now, for purposes of this conversation, let's kind of dissect a couple of things out first. Now, I'm hoping this individual has adequate emergency savings, because what we're hearing now, and what I'm hearing, and maybe you are too, Dee, is so many people talking about the fact that they maybe wish they had more emergency savings. So savings that were liquid, that they could have accessed during this crisis. Because if you actually have to cash your RSP in, you face like a quadruple whammy. So the first thing is that if you're cashing in your RSP, you have withholding tax. So that means the $1,000, let's say you were trying to get out, it means you're not getting $1,000 in your hands. Number two, you lose that room forever. Number three, you actually may be taxed even more next year because you have to include it as income. And then number four, if your investments are down, then you're actually going to be crystallizing that loss. So that doesn't really answer the question, but I kind of wanted to put that out there, that you want to go into your RSP with all of the best intentions that you're not going to touch that money until retirement. Right. If you think you may need to, maybe you should be going into a TFSA, a tax-free savings account, or just saving on the side. Right. So you first need to figure out, do you want it to be in that kind of a shelter or not? So think of that as a garage, right? You still need to park cars in that garage. Could be GICs, stocks, bonds, mutual funds, ETFs, you name it. All of those have varying levels of risk. Mm-hmm. So if we look at the safest, the lowest risk type of investment, which would be a GIC at your bank, a guaranteed investment certificate. The problem with that is, the great thing is, whatever you invest, you put $100 in, you're guaranteed to get that $100 out. And it depends on how long you put that with your bank, you lock it up, that's how much interest you're going to get. But even if you lock it up for the maximum amount of time, you're still getting a very low amount of interest. So that's where people go to the stock market or the bond markets. And if you're very low at risk adverse, you really want to be know yourself as an investor. And that's where I think it's important to have a professional help you out with that. Not to say you can't go with some of the robo-advising platforms out there. They do a good job online getting you to figure out, what assets to pick and your risk tolerance. But again, they're not going to answer those burning questions about RSP versus TFSA versus paying down debt versus savings for an emergency account. Right. So you really need to think about, what your comfort level is, because if you get in and out, and Dee, if we don't get specific questions about the stock market, I can circle back to SK's question. Sure. Yeah, you want to. So if you're thinking about getting in right now, would I go all in today in the market or tomorrow or last week? Well, nobody knows the bottom, nobody knows the top, but maybe a good strategy is to dollar cost average in. But if you're super risk adverse, you want to make sure that, you're not taking a big chunk or you're really easing into the market because you don't want to sell at a loss.
Right. And that's also because there's a lot of uncertainty right now, right? You don't necessarily want to jump in with both feet when there's
Right.
so much uncertainty in the market in general.
Yeah, and maybe now is a good time to bring it up. If you Google the TSX, I was just Googling it this morning for some context for our conversation, and I found some great graphs, and you can even go and see like what it did over the last like day, year, months, all that type of stuff. And just to give you an idea, the high this year was on February 14th, and that was just under 18,000. I won't get into all of the exact. So just under 18,000 was the high of the S&P TSX Composite Index. The low, like not even a month later, was just under 12,000. Wow. So that dropped a lot. But then today we're back up at, and I don't know what it is this minute, but back up to around 15,000. So that is huge swings, right? Just about 18,
volatility,
just about 18,000 to just about 12,000 to back up to 15. Do you have the stomach for that? You got to ask yourself that.
Yeah.
Are you going to be checking that every day and freaking out and worrying about it? Or are you going to be like, yeah, you understand they have their ups and downs. So you really need to know yourself.
Okay. So then this is another question, again, related to RRSPs. Amit asks, what is the best approach for mutual funds in your RRSPs during COVID-19? Do you keep them there or should you convert them to equities?
Okay. Now, so much confusion when it's RSPs and mutual funds and equities. So again, I'm going to just back up. Think of your RSP as a garage and your TFSA is also a garage. If your investments, your cars are in these garages, they have different tax treatments. So in the RRSP garage, you get, whatever's in there, it grows tax deferred and you get a tax deduction when you put it in, but you pay tax when you take it out. You have some special provisions, like if you take it out for the home buyers plan or for going back to school as an adult, you've got some provisions there. The garage of the tax-free savings account, anything that goes in there, you don't get a tax deduction for, but it truly grows tax deferred, truly is tax-free when you take it out. A lot of people are confused about the TFSA because they think it's a savings account at the bank. We see the banks offering, 1.4% for your TFSA.
Right.
It's not exactly the whole story. You can park the same kind of cars in both garages, stocks, bonds, mutual funds, ETFs. So the question was, the mutual funds that they have within their RSP, should they be converting to equities? Now, that mutual fund may be an equity mutual fund. There's thousands of mutual funds in the marketplace. Right. So what this person needs to do is dig into what kind of mutual fund is it? So when we say equities, those are stocks. You can buy stocks individually, again, within your garage or outside, or those stocks are also called equities, can be in the form of a mutual fund or an ETF, things of that sort. So that person needs to dig in. Are they in a balanced mutual fund that has some stocks and some bonds? Are they in a bond fund that doesn't have any equities? Are they in a money market fund, which is actually really safe? Or are they in fact in an equity stock mutual fund? If so, what country, all of that type of stuff. So very important that you know what you're in before you figure out if you should be getting out into something else.
Okay. That's good advice for sure. This is more an RESP question. Jamie asks, my son has another year before university. Should I discontinue funding his RESP and just put cash into a savings account for him? With the way the markets are, I fear a loss to his RESP.
Yes. So here again, here's another garage. This is another garage, is the RESP, the Registered Education Savings Plan. Again, you can put different cars in there, really high risk ones, really low risk ones. So the first question is, should she keep putting money into the plan itself? And then the second question is, what's in the plan that she's been investing in for her son?
Right.
So those are two very separate questions. Now, if she hasn't fully taken advantage of the savings grant that you get when you put money into the RESP, then she probably should keep continuing to fund that, especially if she has a good expectation that her son's going to go to school. The second question is, what should those cars be? What should she invest in? Of course, if her son's going to be drawing on that money right away, you don't necessarily want to be throwing it into the market and worrying about if it's going to be up or if it's going to be down with the swings that we've been having. Right. Safer bet might be a GIC within the plan. It might be maybe a balanced fund or a bond fund or something of that sort. She should talk to her banker or her investment representative or a certified financial planner to kind of figure out, what's in her plan or his plan. How long is he going to be going to school? Because if he's not going to need that last bit of money for maybe 4 or 5 years, maybe a balanced fund is okay. Certainly they need to dig into that, but there's 2 separate questions there to be answered. Going into the RSP and RESP, so many acronyms, RESP, and then what is the underlying investment? So she can still invest in there for him, especially if she hasn't, exhausted the grant, but could go into a safer investment within it.
Right. So you don't suggest just pulling out all your funds and putting it into a basic savings account. That doesn't do anything.
No. And if she's already invested, and let's say the underlying investments was maybe a higher risk mutual fund or something of that sort, pulling it all out right away is not a very good strategy either. And same thing, let's say you are nearing retirement or something of that sort. Remember, her son's not going to need every single cent. He's a year from graduating. That's not the magic day that he's going to need every single cent from that RESP. Right. So if she talks to her professional, maybe if they're, they do need to start easing out of equities or stocks or stock type mutual funds, do it over a number of months or maybe over a couple of years. You don't want to make an abrupt, let's sell today, hoping that that's the good day, because nobody knows whether it's the best day to buy or the best day to sell.
Right, absolutely. So this is more of a generic question then. JJ asks, what type of retirement investment would you recommend this is the wrong question. My mistake. CJ asks, what's an easy way besides RRSPs and TFSAs to invest the money I'm not spending while staying at home?
Okay, so other than that, would simply be to set up an account. You don't have to have something within a shelter. That's only the tax treatment, right? If it's outside, if your cars are just parked on the street, they're not in a tax shelter of some sort, you're going to have to pay tax on them each year, or you're going to have to pay tax on it when you sell it. So again, it's knowing yourself as an investor. The very first question I would be asking yourself is, again, do you have adequate emergency savings?
Yes.
Should you need that? Because there is no sense in investing. And when we say investing, sorry, remind me, Dee, was the question about saving or about investing?
It was just about investing the money.
Investing.
Yes.
Okay.
Yes.
Yeah. So big difference between saving and investing. Saving is like, you're not quite sure what you need the money for. You want it to be safe. Maybe it's a down payment for a house or emergency savings, things of that sort. Investing means you don't need that money for a while. That is money that's going to work. And the reason you don't need it for a while is the longer you don't need it for, and the more comfortable you are with volatility, theoretically, the more you can get as a return, but it may take time. There may be years that you're down, not just the good years. So that could be, again, stocks, bonds, mutual funds, a GIC at the bank. And the great thing is with a mutual fund, for example, and a lot of plans out there, is you can get in for $25 a month. You don't have to have these large dollars. So it's determining, do you need that tax shelter? Like if you're saving a lot, if this individual is investing a lot of money, they need to figure out if maybe they should be in an RSP or a TFSA. Right. And I question why they wouldn't want to go into a TFSA, because it is tax-free. You can buy the same cars in the TFSA or outside. So if you think that you're going to make money and you could be taxed on it, why not put it in the TFSA?
Right.
And then very lastly would also be look at your debt. I just want to make sure that person doesn't have high interest rate credit cards, because Sometimes, we do want to save, and I think that's fantastic. We should always be trying to save, but at the same time, if you've got a 20% interest rate credit card, there's nothing that's going to guarantee you 20% return on an investment. So you're always better to look at that first. The only caveat to that, Dee, though, is that emergency savings account. It's prudent to have that cash available, even if you have debt, because it's there. We've realized that with COVID, right? You need to have that emergency savings.
Absolutely, absolutely. And I think that's actually a point to reiterate, is that debt or not, you need liquid cash. You need money to pay rent. You need money to pay your bills. You need all of that in your hands. So it's probably best to do that before you try to pay down large amounts of debt.
Yeah, and here's the thing too. Some people maybe have fast tracked their mortgages. I was actually a host of a show called Burn My Mortgage. That is a great aspirational thing to do. Again, just as long as you, like you said, have the liquid cash, because you can't go and then, you're stuck renegotiating your mortgage. Or here's something that's been happening from the crisis, since the crisis, not a lot in Canada. And this also was happening in the US post the financial crisis, where let's say you've got a $10,000 credit card limit and you're right up at the limit. Remember, a credit card is a demand loan. The bank can take it away anytime or reduce your limit. And it's not happening a lot, but we have seen stories in Canada where your rate maxed out and now they lower your limit to 8,000 or 7,000, and that excess is due now. Or a case study that I wrote about in my newest book, Talk Money to Me, the individual had, let's say again, $10,000. They were maxed out. They got a little windfall. They got a bonus, and they prudently paid down their credit card, thinking, well, they had $3,000, so they reduced their credit card balance down to $7,000. So they're thinking, if they need to bump it back up, that's their emergency savings, right? Theoretically, that's a good thing. But because this person wasn't always the best with their credit, they missed some payments. Soon as they put that $3,000 down on their credit card, the bank immediately lowered their limit down to 7,000. So again, good strategy, paying down that high interest rate credit card, but not at the expense of, like you said, having that available cash. How much should that available cash be? Most planners say that it should be 3 to 6 months of your household income, but at the very least, it should be what could probably get you and your family through a month or two.
Right. Absolutely. Absolutely. That's the bottom line for sure.
Yeah.
Let's move on to some stock market related questions. Vasudha asks, I think we've covered this, but it's probably better to address it directly. Is this an opportune time to play the stock market? And what would you advise for first-time DIY investors?
Okay, yeah. For first-time DIY investors, you really got to know what you're doing, because then it's just gambling, right? If you're kind of hearing a tip from someone or something of that sort, and you're seeing these wild swings, professionals are professionals for a reason, because they do it every single day, and it's not easy. And I can't tell you how many people have confided in me, because we don't usually tell our friends and coworkers when we lost money in the market. We talk about when things are going well. And I had a lot of very, very smart, astute people tell me that, they were riding really high on all these cannabis stocks and things of that sort a couple of years ago, and really lost a lot recently. And, you just don't go tell that. So you can be riding high for years, but if you don't know when to get out, you don't know when to get in, trading individually can be very hard. Now, having said all of that, I don't want to discourage you from having, experiencing some investing with your money. Maybe you do the Warren Buffett strategy, where 80-90% of it is prudently invested. You're with a professional, but your industry, and you maybe have an inside interest and knowledge in some sector. There's nothing wrong with taking 1% or 10% or whatever, as long as that's not going to make or break your retirement. It's not going to make or break your sleep patterns at night. If you lose it all and you're really going to go all in, you can open up a direct investing account with your bank. Most banks have the brokerage arm where you can start to play around and things of that sort. Maybe a great way to get your feet wet. Maybe a good idea too is to start an investment club with some friends. And you can actually formally set these up with your bank, where you all come in maybe with a couple $100 and you're going to invest as a group and learn as a group. And that might actually be a fun thing with COVID is, right, is to like start a little investment club. You could do a fake one where you're just trying it out to see if you actually would have made money, or you can actually get all in with money and pool your assets so you can buy more things. But I just wouldn't make a DIY project your main dollars to think that you can capitalize on all these swings, because then none of the people in the financial industry would be around. We would all be,
absolutely. But so coming back to the question of whether this is the right time though, just given the, the financial instability in the markets right now.
Right. I think there's always a great case to dollar cost average in no matter what. So when I was telling you just a little bit ago at the top of this, how much the S&P 5 or the S&P TSX Composite Index has gone up and down in the last number of months. If you're dollar cost averaging in every single month, it's always a case that you're better to be invested than not invested. And that way you're going to spread out your risk. Because you're not trying to time the market. So if you have a prudent strategy like that, as long as what you're investing in meets your risk tolerance, then now is as good of a time as any to dollar cost average in.
Okay. So because I'm absolutely uneducated, can you explain dollar cost average in?
Sure. Thank you. So if you took $1,000 today and just hope that it was the right day, it may or may not be the right day. But a more prudent strategy would be take that, let's say it's $1,200 just for the sake of easy math. Instead of investing the $1,200 today, you're going to invest $100 on the first of every single month over the next year.
Okay.
Right. So where the dollar cost averaging comes in, and thank you, Dee, because sometimes we forget that these are not known by most people, never mind everyone. So you're going to average, and it's who knows what it's going to be in February, March, and April. But at the end of the year, the strategy is that the average is going to benefit you more so than trying to just pick the one day of the year to throw that $1,200 in. So if you do that, it's you're spreading out your risk and potentially even increasing your return.
Okay, that makes a lot of sense. Yeah. Okay, and I get it now. Financial terminology, and I think finances, especially for first timers, is such a difficult thing to get into. So it's good to know like all of the little terms and things.
Yeah, and we're scared to ask because we think we should know. We didn't learn this in school. Why would you know?
Yeah, exactly.
Yeah.
Okay, so here's one. I think again we just about. Okay, these are more about future planning because again, like you said, you need savings, you need all of these things. So we've got a question that came in on Reddit. This person's alias is Purple Panda Paradox. Purple Panda Paradox asks, if someone still has a job, what should they do now to financially prepare themselves for possible layoffs?
Okay. Yeah. Oh, wow. That's a really great question. So what you want to do, and actually what everyone should be doing in crisis, if you're safe, but especially if you don't know if you're going to have a job next week or next month, is you've got to do an inventory of all of what you have to pay out in a month. So not just your debts, but what you have to pay out. What are your utilities? What are like just get into everything. Create either just write it down in a little chart or a spreadsheet, because everyone's like, not everyone, but most of us have kids at home or cats at home and spouses. And there's a lot of confusion. You might forget or miss payments. So you first want to take an inventory. What do you have to pay over the next 3 months? Then what you want to do, and again, if you're working, but you're a little worried, great to be preemptive, then create another column and figure out what can you defer if you have to, and then get on with your bank. I know it's really long wait times right now if you're calling your bank. So what you want to do is get online or open up your app and book an appointment. You can book an appointment with your bank for them to call you back at a set time. And a lot of my readers and people that are reaching out who've done this have reported that the banks have been great. They understand that millions of people are going through the same uncertainty or actually in crisis mode. So they are really willing to work with you more so than ever before. And actually they were pre-COVID too. But anyway, it's hard for people to reach out. So please be reassured that they know why you're calling and they want to help. So book that appointment, have a conversation with them. and just say, look, here's what you owe. Here's if you've got credit card debt, you've got a mortgage, things of that sort, and see if they'll work with you. The Canadian Bankers Association has said that 90 to 95% of the time when people are reaching out to their bank, they are giving them a deferral. If you have a credit card balance, here's something for everyone watching. If you've got a credit card balance, especially if it's a high interest rate credit card, make sure you contact your bank and get a deferral on your credit card, even if you don't need it. And here's why. Because if you're at 22%, they'll cut it in half, but only if you get the formal deferral. Now, here's the caveat. You want to still keep making your payments, still make your minimum payment and more, but why not take advantage of getting that credit card interest rate cut in half for the next 3 months? Now, so you've made an inventory of everything. You've contacted your bank. Then you want to see who else is going to work with you, in deferring utilities or property taxes. You want to know all the government benefits out there if you should need them, and start to make little ticks. I can't defer that. Like, you don't want to defer your internet and your cell phone. You want these things to not be cut off. Okay. So like being careful too, to make sure you're watching your due dates for stuff like that, because a lot of provinces have, the utility companies have agreed to defer your payments, but not your cell phone company. Like, you do not want that lifeline cut off.
Right.
And then you want to also put a little reminder in your, your calendar for all of these dates. And if you've made deferrals and things of that sort, because you don't want to forget about them. And then very lastly, if you think that you're safe now, but you might not be in a week or two, don't wait to make the deferral. Because if your mortgage is coming up or your credit card payment is coming up, it's going to take about 5 business days for that deferral to kick in. So you don't want to be calling 2 days before. This is why being preemptive is so fantastic for this person. Purple
Panda Paradox.
Purple Panda Paradox. You say it much easier, Dee. So definitely, again, it can be really hard for people who have never had to look their finances head on like this and have conversations with their employer or their landlord or their bank. But knowing your options, it's just, you're going to have such a sigh of relief after, and keeping track of it and then automating it, putting it in your calendar so you don't even have to think about it. Super, super important.
That's some really good practical advice, though, for sure, because right now the banks, the government, they've put in so many things in place in order to help people get through this time. And like you said, you might not even think you need it, but it's a good thing to take advantage of so that it helps you sort of stay afloat.
Yeah, because maybe, and for mortgage deferral, let's talk about that for a second. In most mortgages, even regardless of COVID and the 6-month deferral that the government had got the banks to work on, you were able to skip a payment once per year on your mortgage with no penalty. That could put hundreds, if not thousands of dollars into your bank account right now when you might need it. So if you don't have an emergency fund, that might be something that would be really helpful. Of course, only if you're a homeowner.
Absolutely. Okay, well, we've got time, about 3 minutes or so for one last question, so I'll try and squeeze it in. This is moving over to the housing market now, and this is sort of a catch-all question. Joe asks, will the housing market crash in 2020?
I don't think anyone has that crystal ball. I mean, here's the thing. People are still at some point going to be coming to Canada. I mean, we have a lot of people coming to this country. That'll happen again after COVID. We're not disappearing. Are we going to face some type of declines? It's like the stock market. Absolutely. Is it going to crash? I mean, we don't have that crystal ball, but I doubt it's going to crash.
Okay, so we still have more. We have time then for more questions. We'll continue on with the housing market then. Should one consider entering the housing market right now during COVID-19? There's concern around the stability of current jobs and how they're going to be downsized or will evolve. So is it wise for a first-time buyer to get into the housing market right now, or should you wait and watch?
This is, again, knowing yourself. Are you going to want to, is this something that you're just thinking about getting in because you think there's deals to be had? because like anything, shopping the sales rack doesn't necessarily fulfill the need. Sometimes we're led with that. So you want to be really careful. Are there deals? Absolutely. In some cities there are, but you want to make sure that that is a sound, prudent strategy for you, that you're ready to get into the market. You're ready for the excess costs that can be had with home ownership, and that you're willing to stay put, because moving is also very expensive. This is something that can cost you a lot over time. Do you have, do you have those emergency funds, not just for yourself, if it's a stretch to get in? But I also have to say, I mean, the conversation could be had, did homeowners fare better during COVID than those renting? And I think the answer is yes. If you let all things equal, if you did not have adequate emergency savings, if you lost your job, if you didn't have investments to pull on, homeowners, I think, had a lot more advantages with deferrals, because then those deferrals are rolled into your amortization at the end, as opposed to if you couldn't pay rent for 3 months and were lucky enough to get a deferral, you still have to come up with that 3 months at the end of 3 months.
Yes.
So it does beg a larger question: is home ownership right for that person? And regardless of what's going on with the market, please make sure it's right for you first before you get in, because it doesn't matter if you're getting something on sale. If it's not right for you, it may cost you a lot down the line.
Right, absolutely. And that brings us exactly to our half-hour mark. That's perfect. Thank you so much. This was so informative. And I hope everybody who asked got their questions answered.
They were great questions.
I'm so glad you thought so, because financial aspects of things are not my strong suit. And so
you did great, Dee.
Thank you kindly, as did you. I'm so glad that this was a really, really informative conversation. Thank you so much for joining us, Kelley.
Such a pleasure.
And for everybody watching, we will have a lot of this chat transcribed on our website, and you can catch this chat. You can watch the whole thing all over again. It'll be there on our website. Thank you so much, Kelley.
Thanks, Dee.
All righty. Bye-bye.
Bye.